Okay, so here's the thing most textbooks skate past. After World War I, Europe wasn't just tired, it was insolvent. Factories smashed, trade routes broken, and tax bases gutted. On paper, reparations were supposed to rebuild order. In practice, they drained cash from already stressed economies. Gold, the anchor of the pre-war system, had pooled unevenly. The US was a creditor nation and a gold magnet. Europe, especially the defeated and the peripheral, bled metal. Britain faced the sharpest dilemma. London still ran the world's credit switchboard, shipping, insurance, commodity trade, sterling finance. But the Bank of England didn't have enough gold to support the pre-war parity and the old aura of sterling strength. If Britain devalued, the empire's contracts, debts, and prestige all took a hit. If it didn't, domestic deflation and unemployment would get worse. That's the trap. Keep empire credit without the metal to back the story. Across the Atlantic, the US held the chips, industry intact, farms scaling, treasury flush, and vaults swelling with gold inflows. But Washington wasn't eager to run the show. Leadership meant opening markets, lending abroad, and potentially tolerating trade deficits, politically hard. The practical question nobody wanted to say aloud was simple. How do you run a high-speed global trade network when the primary lubricant, gold, is scarce and sticky? Here's what actually happens when you try to restart commerce without enough metal. Banks need reserves. In the classical model, those reserves are gold. But real trade demands elasticity, credit that can expand and contract with shipments, harvests, and inventories. Gold doesn't flex on demand. So before any public fix, private habits took over. Sterling had been the world's working capital for decades. Banks, merchants, and central banks were already used to holding sterling bills and deposits as a proxy for money. Quiet coordination between central banks, informal understandings about settlement preferences and support, was already flickering. By 1921, reality forced the conversation. Either the world deflated hard to fit the gold stock, or policy would economize on gold. That word, economize, became the euphemism for leverage. If central banks could count foreign currency deposits as reserves, then gold could sit at the top while sterling and rising fast dollars formed layers beneath. You get a reserve pyramid, an ounce at the apex, claims on issuers in the middle, banking liabilities at the base. 1 ounce now supports more money, more trade, and this is the catch, more fragility. So why Genoa and why 1922? 2 reasons. First, politics needed a veneer of consensus. A multilateral conference gave cover for national choices that were already underway. Second, credibility. If you're going to swap metal for claims, you want the world to agree that claims count. 34 nations sent delegates to the Genoa International Economic Conference. The public agenda was stability and reconstruction. The private objective was to lock in a standard that could function without hauling more gold into Europe. Think about Britain's incentives. If other central banks agree to treat sterling deposits at the Bank of England as reserves, then demand for sterling rises by design. That props up sterling's exchange rate, lowers Britain's funding costs, and stretches scarce gold further. For the US, still cautious about leading, the arrangement didn't look bad either. Dollars would soon join sterling as reserve material, giving New York quiet leverage without a messy treaty that said, America runs this. Now you might be thinking, wasn't this just common sense? Trade needed money, money needed to grow. True, but the method mattered. Instead of admitting they were building credit on top of credit, policymakers baptized the process with careful language. Resolution 9 at Genoa would later say the quiet part neatly. Central banks could maintain reserves in the form of foreign balances. That single phrase downgraded gold from the only real reserve to the apex of a layered system. Once claims on issuers count as reserves, the issuer's deficits become everyone's assets. Everything changes when the reserve asset is also someone else's liability. In a metal system, confidence runs at the vault. In a claim-based system, confidence runs at the issuer. If Britain or later the US runs persistent deficits, the world accumulates their liabilities as reserves. Demand for the issuer's currency props up its deficits until doubt creeps in. Then you don't get a gentle adjustment. You get a rush to convert claims, a scramble for collateral, and a sudden stop in credit that feels like the floor dropping out from under wages and trade. Here's a quick micro story that captures the mood at the time. A mid-sized continental bank in the early 1920s wants to expand trade finance but can't source enough gold. Its treasurer shifts reserves into sterling deposits in London, earning a touch of interest and buying political goodwill with the city. Business grows. Local exporters get paid faster. Confidence looks restored. But silently, the bank's reserves now depend on London staying strong. That's fine until it is. This is the part people missed because the numbers looked good. Imports rose, exports recovered, credit flowed. Yet under the surface, reserve quality had changed. Gold was slow but final, foreign balances were fast but conditional. And when conditions shift, rates move, narratives wobble, or a shock hits, conditional reserves turn into collective fragility. That's the setup. Europe's broke, empires want credit, and the US is powerful but hesitant. The system needs elasticity without metal. Genoa is where they decide to write that elasticity into the rulebook while calling it stability. Genoa 1922, the meeting that rewrote money. Here's what actually happened in 1922. Genoa wasn't a quaint seaside chat, it was a hard reset. 34 nations showed up, but the real gravity sat behind the ministers, experts from the Bank of England orbit, French and Italian technocrats, and Americans watching carefully. The public script said restore stability after the war's chaos. The private goal was bolder, build a system that looked like gold without needing much gold. Most people think a standard is a metal. In Genoa, the standard became a vocabulary shift. For the first time in an international forum, the phrase gold exchange standard got elevated from expert shorthand to policy architecture. It sounds like semantics, but this is where definitions turned into power. If you can call a claim on someone else's currency a reserve, you've replaced settlement with promise. That's quieter leverage, blessed by multilateral consent. Let me show you the hinge point. Resolution 9. Buried in polite prose, it recommended that central banks economize the use of gold by maintaining reserves in the form of foreign balances. That line did three things at once. 1, it legitimized sterling and soon after dollars as reserve material. 2, it allowed the same ounce of gold at the apex to support multiple layers of claims, London's liabilities, then Europe's liabilities based on London, and so on. 3, it created a path for central banks to coordinate support without calling it a pact. But here's where it gets interesting. Genoa also sketched informal norms for central bank to central bank alignment. They talked about smoothing exchange rates, preferring official channels for settlement, and quietly pooling support when a key currency wobbled. No one signed a mutual defense treaty. They didn't have to. By agreeing that foreign balances count, they tied everyone to the fortunes of the issuers. Support the issuer and your reserves hold. Doubt the issuer and your reserves melt. Now this is important because it turns discipline inside out. Under classic gold, if you ran a deficit, metal walked out of your vault and forced you to tighten. Under gold exchange, if you ran a deficit but the world needed your currency for reserves, demand for your liabilities could keep your exchange rate stronger than it deserved. Britain understood this instinctively. If sterling deposits at the Bank of England were treated as high-grade reserves in Paris, Rome, Amsterdam, and beyond, then sterling's ocean would stay deep even with less gold underneath. Everything changes when ministers step out and the technicians take over. Picture the backroom arithmetic. If a central bank holds £10 million at the Bank of England as a reserve asset, and London itself holds less gold than its sterling promises, then 1 ounce now supports several steps of liabilities. That's the reserve pyramid, gold at the apex, sterling and later dollars as middle layers, banking deposits and loans at the base. It oils trade and credit. It also sets you up for sudden stops if confidence snaps. Once you grasp that, the rest of Genoa makes sense. The conference didn't restore the pre-war gold standard. It replaced it with a hybrid that could scale. The gold exchange standard was the first formal admission that liquidity would be created through trusted claims, not metal alone. The phrase "economize on gold" hid the leverage. Foreign balances hid the dependency. And because this looked technical, it slid past the public. Voters got stability. Central banks got flexibility. Issuers got seigniorage. Let me add one more layer. The sterling-dollar handoff was already implied. The United States had the gold and industrial muscle. New York's markets were rising fast. Even if Washington didn't want the leadership badge, the architecture pointed that way. Once foreign balances were respectable reserves, the world could hold dollars as easily as sterling. When sterling later strained, the dollar slot was pre-cut. Genoa didn't crown the dollar, but it carved the path. You might be thinking, wasn't there any pushback? Quietly, yes. Some delegates worried about confidence substitution, replacing metal trust with issuer trust. If the issuer inflated or politics turned, reserves could vanish in a rush. But the counter-argument won the day. Trade needed elastic money. Gold was too scarce to do the job alone. The compromise was to put gold on the letterhead and build a claim-based machine under the desk. Here's a 20-second story from that week. A French advisor asked a British official, "What happens if sterling is tested?" The answer, "Then we support it." The French, with what? The British, with each other. That's the whole game. Once reserves are claims, the solution to stress is coordinated support until it isn't enough. Sounds technical. Here's how it rigs your life. When reserves are claims, the issuer's policy steers your prices. If the issuer runs deficits, the world still needs its paper, so liquidity stays easy for assets before it trickles to wages. When doubt hits, the rush for collateral tightens credit first, raises mortgage spreads second, and squeezes payrolls last. The blueprint was drawn in Genoa. The rest of the century just scaled it. How the gold exchange standard actually worked. Okay, so let's strip the jargon and show the machine. Start at the apex, gold. That's the final settlement asset. Beneath it sits a new layer, reserve currencies, first sterling and then the dollar. Beneath that, commercial bank deposits and credit. The trick Genoa authorized was simple. Let central banks count foreign balances at London or New York as reserves, almost like gold. Once that's allowed, the whole pyramid stretches. Here's the leverage math in plain English. Suppose a central bank holds £10 million at the Bank of England as a reserve asset. The Bank of England itself is promising sterling convertibility while holding a finite pile of gold. Meanwhile, local banks at home lend more because their central bank has reserves. 1 ounce at the top now supports the Bank of England's sterling liabilities plus multiple layers of domestic banking liabilities abroad. It's not fractional reserve banking once. It's fractional reserve banking stacked across borders. Now this is important because it changes how deficits settle. Under classic gold, if you imported more than you exported, gold flowed out and forced you to tighten. Under gold exchange, settlement could happen with claims, not metal. If you ran a deficit but your currency was a reserve, foreigners held your IOUs as assets. The debit didn't trigger a gold drain, it became someone else's foreign balance. The pressure that would have hit your vault got diffused into balance sheets worldwide. But everything changes when confidence becomes the collateral. Those foreign balances are just someone else's liabilities. If investors believe sterling or dollars are as good as gold, the pyramid stands tall. Demand for the reserve currency props up its issuer, allowing larger deficits with fewer immediate consequences. That's the seigniorage bonus. Currency demand from the world becomes the cushion that lets the issuer spend more and borrow cheaper than peers. Let me show you the settlement games this enabled. Imagine country A runs a deficit with Britain. Instead of shipping gold, its central bank accumulates sterling deposits in London, labeled as reserves. Locally, policymakers say, "We're fine, our reserves rose." But what rose were claims on London, not metal. London then uses that steady foreign demand to fund its own positions and, critically, to roll its short-term bills cheaply. The circle completes when country A's commercial banks, seeing healthy reserves, expand credit at home. Trade grows, but so does the hidden leverage. Once you see the loop, the feedback becomes obvious. More global demand for the reserve currency makes its deficits easier to finance. Easier financing sustains the narrative of strength, which invites even more demand for the reserve currency as a store of value and reserve asset. That self-reinforcing cycle powers boom times. It also plants fragility. If the story turns, nobody runs to the gold window first. They run at the reserve currency claims. That's a run on the middle layer, not the apex. Confidence substitution is the core risk. The system works only as long as everyone believes claims are near gold. But claims are conditional. They depend on policy, politics, and the credit of the issuer. If interest rates jump, growth stalls, or a scandal hits, the appetite for those claims can evaporate fast. Then you get the modern version of a bank run. Not crowds at branches, but silent balance sheet compression. Margin calls, collateral haircuts, and funding lines pulled at 3 a.m. Here's a quick micro story to land it. A merchant bank finances commodity shipments using sterling bills, funded partly by deposits from a European central bank counting those deposits as reserves. Shipping thrives, fees look steady. Then a shock hits, sterling credibility wobbles. Overnight, counterparties widen haircuts on sterling collateral. The merchant bank's funding cost jumps, it marks positions down, and the European central bank quietly rolls into dollars to diversify. Nothing exploded on Main Street yet, but funding dried up. Weeks later, credit to exporters tightens and prices shift where you feel it. You probably see the pattern interrupt. Gold exchange stability was real until it wasn't, because the stability sat in belief, not bullion. By legalizing foreign balances as reserves, Genoa let the same ounce back multiple tiers of liabilities. It was elegant engineering, more trade, more credit, fewer trains of gold crossing oceans. But the price of elegance was sensitivity to narrative shocks and policy mistakes by the issuers. There's one more wrinkle. Because the reserve asset is the issuer's liability, the issuer's central bank has disproportionate sway over global conditions. A rate move, a convertibility signal, or a hint of deflation ripples down the pyramid. Asset prices adjust first, wages last. That's why boom-bust cycles in reserve centers show up as mortgage spread swings and credit rationing far away from the issuer's capital. So yes, the system worked, until the first rupture showed how fast confidence can flip. When that middle layer shakes, the run isn't on gold, it's on claims. And when claims are what your bank and your mortgage depend on, the shock doesn't feel international. It shows up as a higher rate on Thursday, false ending one, credit line the 1920s stability that wasn't. It looked like calm. Trade rebounded, ships moved, and headlines praised restoration. Sterling wore its old suit, the dollar rose without boasting, and central bankers congratulated each other for rebuilding order. But here's what actually happened. The gold exchange scaffold made everything look stronger than it was. Credit expanded because reserves rose. But reserves were increasingly foreign balances, claims on London and growing quickly New York, not metal. That subtle shift hid the imbalance that would decide the decade. Most people think the 1920s boom was organic growth. Under the surface, U.S. credit quietly fueled Europe. American lenders and markets recycled surplus savings into loans, securities, and bills that propped up foreign balance sheets. Meanwhile, a lot of incoming gold to the U.S. was sterilized, neutralized, so it didn't fully expand domestic money. The appearance of plenty coexisted with tight discipline at the core. Abroad, the opposite, plenty of claims, thin metal. It worked until the story wobbled. Now this is important because it set up a carry trade that printed easy profits while tightening the spring. European institutions could borrow short in sterling or dollars and lend longer into local assets that looked stable thanks to the reserve pyramid. Central banks saw healthy reserves and kept the music on. Issuers enjoyed seigniorage, global demand for their liabilities, so deficits didn't bite immediately. The loop reinforced itself. Stronger narrative, tighter spreads, more issuance, higher dependence on the middle layer of claims. Let me drop a 20-second micro-story that played out dozens of times. A merchant bank in Amsterdam finances Baltic grain shipments. Funding comes via sterling bills, sweetened by deposits from a Scandinavian central bank that counts those deposits as reserves at the Bank of England. Margins look safe, volumes grow, and bonuses get booked. Nobody asks what happens if counterparties widen haircuts on sterling collateral. Then a rumor hits, haircuts nudge wider, and the merchant bank's blended funding cost jumps 75 basis points in a week. The deal book still works, but only if prices don't slip. They slip. Everything changes when the 1929 shock hits U.S. risk assets. Equity breaks aren't the whole story. They're the signal that credit is repricing. As U.S. conditions tighten, the dollar layer hardens. Cross-border funding that looked perpetual turns fickle. Banks that had counted foreign balances as rock-solid reserves start to question their liquidity horizons. You don't see a queue at a gold window first. You see dealers step back, bill spreads widen, and rollover risk rise for the institutions sitting on those claims. Then comes 1931, the sterling crisis. Here's what actually happens in a claim-based reserve world. When confidence turns, the run targets the issuer's liabilities, not the metal directly. Foreign holders try to convert sterling claims into gold or dollars, or they simply refuse to roll bills. The Bank of England, with less metal than its towering claims implied, faces a brutal math problem. Support sterling with higher rates and pain the economy, or let convertibility go and break the facade. They choose the break. Sterling leaves gold. The gold exchange standard doesn't die from a lack of metal, it dies from a lack of belief. Now you might be thinking, wasn't the 1920s stability real while it lasted? Sure, like a bridge carrying more trucks than its rating. Throughput looked fine right up until the stress test. The illusion rested on three props: U.S. credit recycling into Europe, the use of foreign balances as reserves, and the narrative that gold convertibility at the apex guaranteed the middle layers. Once the apex was doubted through the middle layer, issuer trust. The math of the pyramid flipped into a scramble for settlement assets and highest quality collateral. Here's the twist that matters for your world. The break didn't start with households, it started with balance sheets.